Welcome back. In the last lecture, I introduced the concept of trading strategies, where we started talking about combinations of options and the underlying asset. I had discussed the covered call strategy, where we have a short position in the call option and we protect our liability arising from that short position by taking a long position in the underlying asset. We also talked about a protected put strategy, where we protect a long position in the underlying asset by buying a put option on that, so that if there is a decline in price of the underlying asset, we get protected, we get insured against that decline in price by buying a put option. We talked about straddles, which involve a long call and a long put, and we discussed the investor perceptions in the context of a straddle strategy, where the perception is that the volatility of the underlying assets prices would be very significant as on the date of maturity, although the direction on which the volatility would operate is still uncertain. The prices could go up significantly or the prices could go down significantly, depending on the outcome of a event in the life of the enterprise. Then we started talking about a strangle strategy. Now, a strangle strategy is very similar to the straddle strategy. In the case of a straddle strategy, we have two options, a long call and a long put, but the exercise prices and maturities of both the options are the same. However, in the case of a strangle strategy, although the maturity of the call and put are the same, the exercise prices, the strike prices are different. The strike price of the call option and the strike price of the put option are different from each other. So, there can be two situations, one in which the call option strike price exceeds the put option strike price, and the other which is the inverse of this scenario. Let us talk about the first case, where K C is greater than K P. Now, as you can see in this diagram, we can split the entire spectrum of possible stock prices on maturity into various segments, into various partitions, 0 to K P, K P to K C, and beyond K C. Now, if the stock price, if the underlying price is between 0 and K P on the maturity of the option, the put option would be exercised, but the call option would not be exercised. And if the stock price ends up on maturity of the options between K P and K C, you find that neither the put option nor the call option gets exercised. Both the options lapse without being exercised, because the price is lower than the exercise price of the call option. So, you do not exercise it. The price is higher than the price of the put option, exercise price of the put option. So, you do not exercise that either. But if the price ends up beyond K C, then it is profitable for the investor to exercise the call option, but obviously not the put option. So, that is these are the three possible scenarios. If S T is less than K P, put will be exercised, call will not be exercised. If K P is less than S T is less than K C, then both will lapse, neither of them will be exercised. And if the stock price ends up beyond or in excess of K C, then only the call option gets exercised. The payoffs corresponding to these three respective states, possible states, are tabulated here in this table, and you find that the total payoff on maturity in the three respective situations is K P minus S T. If the price is less than K P, it is 0 if the price ranges between K P and K C, and it is S T minus K C if the price goes beyond K C, and the cost of setting up of the strategy is obviously C plus P. The salient parameters of this, the maximum profit, as you can see in the diagram, the maximum profit, if you can, as you can see, is unbounded on the right hand side, and depending on what on the higher side of the underlying price, if the price goes up, the beyond K C, the profit becomes unbounded as the price increases. beyond Kc. The maximum loss, if you can see, is confined to the premia of buying the call and the premia of buying the put options. The aggregate premium of setting up of the strategy is the maximum loss that can arise from from the strategy, and the break even points are given by these 2 points, which are Kp minus C plus P and Kc plus C plus P. So, the analysis of this is more or less on the same lines as the straddle, and in fact the other case that we have Kc of being Kc less than Kp is also very similar. The only difference is in this case, if the price ends up between the two exercise prices, that is Kc is less than St is less than Kp, then both the options would be exercised. Both the options would be exercised, the call option as well as the put option get exercised, but the effect is that because yes, both the options get exercised, and as you can see in this particular case, this is the exercise of the put option, this is the exercise of the call option, and the St factor cancels in between, and therefore, you have a constant payoff. Now, in the previous case also we had a constant payoff between the intermediate two prices Kc and Kp, because neither of the two options were exercised. Here we are again having a constant payoff, but here we are having a constant payoff because both the options are exercised, and therefore, the profit made on one is annulled by the loss made on the other option. So, in this case you can see that the coordinates of the maximum loss turn out to be Kp minus Kc minus P plus C. In the previous case it was simply P plus C. So, this is a slight difference if Kc is less than Kp, or otherwise the analysis remains absolutely parallel to what we discussed for the earlier case. Now, as far as the sign of this particular expression is concerned, Kp minus Kc minus P plus C, it is clearly less than 0. Therefore, we have a diagram of this nature as we had in the previous case, as we had in the case when Kp was less than Kc, we have a similar diagram. This coordinate would be negative, as you can see, as we can arrive at by using the put call parity relationship. Investor perceptions we have discussed. Investor perception as far as straddles are concerned and strangles are concerned remains again more or less similar. The investor who is taking a long position in a straddle or a strangle perceives a high volatility in the price of the underlying asset as on the date of maturity, as on the date of exercise of the two options. Now, we have variants of straddles in strips and straps. In the case of a strip, what happens? We take a long position in two put options. In the case of a straddle, we had a long position in a call and a put, long position in one call and long position in one put. One call which gave us this diagram and the long put which gave us this. Now, in the case of a strip, what do we have? We have two puts here. We have two puts instead of one put, and we have one call. And similarly, in the case of a strap, we have two calls and one put constituting the strategy. So, a strip consists of a long position in two puts and one call, whereas a strap consists of a long position in two calls and one put. Now, again if you look at this diagram, you can immediately infer the investor perception. The investor perception is clearly that the stock price is volatile, the stock price on maturity of the option is likely to fluctuate significantly, but here you have a directional preference. In the case of a straddle, you are neutral to the direction of the movement of the stock price. You are not pretty sure, not much conversant with the direction of movement of the stock price, whether it is going to increase or whether it is going to decrease. You had given equal weightage to the increase in stock price and the decrease in stock price. The probabilities as per your perception were more or less similar. Here the situation is slightly different. For example, this is the case of a strap. In this case of a strap, you are having two calls and you are having one put. So, your perception is that there is a greater chance that the stock price would move up, and because you have a perception that the stock price is going to move up, you want to bet in favor of that particular perception. So, that if the stock price moves up, you make a greater profit per unit change in the price of the stock. If you look at the strategy carefully, 1 unit increase in the price of the stock results in a 2 unit increase in your profit if the stock price exceeds k. On the other hand, 1 unit decrease in the stock price results in only 1 unit increase in your profit if the stock price moves in the downward direction. So, here you are having a particular perception and a biased perception, a biased probability that the stock price is going to move in a particular direction. In the case of a strip, your perception is that there is a greater chance of the price moving downwards rather than the price moving upwards, and therefore, you bet in favor of the price moving downwards. If the price moves downwards, you get 2 units of profit for every 1 unit change in the price. As you can see, this angle turns out to be tan inverse 2, this angle turns out to be tan inverse minus 2, because you are having 2 calls. Now, the important thing I would like to emphasize here is these are strategies where you are having 2 calls. You could as well have 3 calls, 5 calls or 10 calls. It really depends on what is your perception and how much risk you are willing to take, how much bets you are willing to take on a particular directional movement of the price of the underlying asset. Obviously, the profit increases with that, but at the same time the price of setting up of this strategy also increases. And these are the salient parameters. This is the profit function, and the maximum profit again is infinite in either case. The maximum loss is confined to the premia that you have paid. For example, in the case of a strip, you have two put options. So, the premia of 2 puts and 1 call, all of them are long. So, this is the plus sign, this is the total premia that you have paid. The entire thing is an outflow. The break even points are given by these 2 stock prices, and note this factor 2 because you are having 2 puts, and in this region the put is exercised 0 to k, the put is exercised. So, your profit increases by 2 units for every unit price fall, and in this case for greater than k region, for a ST greater than k, the call is exercised, but you have only 1 call, and therefore, the price increase is only 1 unit per increase of 1 unit in the stock price. The same scenario arises in the case of a strap. Now, we come to a very important type of strategies which are called spread strategies. Now, in the definition, the collective definition of spread strategies is that they consist of long and short positions in options of the same type. For example, long and short positions in calls, long and short positions in puts, these constitute strategies. Now, there are spread strategies. Now, there are different types of spread strategies. We have vertical spreads, we have horizontal spreads, and we have diagonal spreads. In the case of vertical spreads, the combinations that we are talking about, the long and short positions, they have different exercise prices. That is, K A is not equal to, suppose there are 2 options K A and B, then K A is not equal to K B, but the maturity is the same, that is T A is equal to T B. In other words, the maturity is the same of the 2 options that constitute the spread, but the exercise prices are different. So, one of the options would have a lower exercise price, the other would have a higher exercise price. We will talk more about that, but the maturities would be the same. In the case of horizontal spreads, what happens? The maturities are different. T A is not equal to T B, but the exercise prices are the same. And in the case of diagonal spreads, both the things vary. So, in case of diagonal spreads, we may have K A is unequal to K B, T A is unequal to T B. From the analysis perspective, the vertical spreads are the simplest to analyze, although the principles that are epitomized in case of vertical spreads carry on or carry forward more or less identically to the analysis of the other types of spread strategies. Now, there are different types of vertical spreads also. We have got bullish vertical spreads. Why they are called bullish? We will come back to it in a minute. But we have bullish vertical spreads with call options, we have bullish vertical spreads with put options. Then we have bearish vertical spreads with calls and bearish vertical spreads with put options. We have butterfly spreads also with calls. We have butterfly spreads with put options also. Then there is something very interesting called a box spread. So, I will briefly allude on this. I will take up one of these strategies in detail, and the others are more or less similar. So, let us start with the simplest case, which is the bullish vertical spread with call options. Now, in the case of a bullish vertical spread with a call option, the first thing is why it is bullish. I will come back to it in a minute, but the strategy consists of buying a call option and selling a call option. As I mentioned, when we have a spread strategy, we take a long position in one option and we take a short position in the other option. So, in this case we are buying a call option A and we are selling a call option B. But because they are vertical spreads, we are having different strike prices, different exercise prices, we are having the same maturity. The maturity is the same, as you can see. The strike prices are different, K A and K B are the two different strike prices, and obviously the call prices will be different, C A and C B, the premium would be different. In this case we assume K A is less than K B. Why we assume this will be clear from the figure. And in fact, there is a nexus between this term bullish and this K A is less than K B. They are interrelated. We will discuss this now. Now, what happens now? If you look at this diagram, we can split up the entire stock price possibilities or entire values that the stock price can take on maturity. Remember, there is only one maturity date, and the stock price can either end up between 0 and K A, because K is less than K B. So, 0 and K A, or between K A and K B, or between K B and infinity, that is beyond K B, it can be more than K B. Now, if it is between 0 and K A, then it is less than the exercise price of call A, it is less than the exercise price of call B. So, what happens? Neither of the two calls will be exercised, neither call A will be exercised, neither call B will be exercised. Now, if the stock price on maturity ends between K A and K B, that is in this region, then it is greater than the exercise price of call A, but it is less than the exercise price of call B. Because it is greater than the exercise price of call A will be exercised. Call A will be exercised and you will get a payoff of ST minus K A. This will happen when the stock price ends up on maturity between K A and K B. This is what you are going to get. Why? Because K A is smaller than K B, number 1. So, K A will occur first. So, if the stock price goes beyond K A, as soon as it goes beyond K A, it would be profitable for the investor who has created the strategy to exercise call A, and once he exercises call A, he gets this much amount of money. Obviously, the party in favor of whom call B is written will not exercise that call, because he is not going to get any payoff out of this. So, ST minus K is what he is going to get. You can clearly see as ST increases, the payoff increases, and this angle in fact is 45 degrees. So, for every 1 rupee increase, this coefficient is 1, therefore, this angle is 45. So, for every 1 rupee increase in the stock price, there is a 1 rupee increase in the profit of the strategy. This continues up to K B. What happens if the stock price goes beyond KB? Now, if the stock price goes beyond KB, then obviously call A will continue to be exercised, because KB is larger than KA. So, if the stock price is greater than KB, then automatically it is greater than KA by default. Therefore, if it is greater than KA, then call A continues to be exercised, but the party in whose favor you have written this call will also exercise the call, and as a result of which you will incur a loss. You will start now paying money to him. So, what is the net payoff that you are going to get? The net payoff that you are going to get is ST minus KA, that is what you are going to get on your long position in call A, minus ST minus KB, that is what you are going to pay on the short position on call B, which will now be exercised because the stock price is greater than KB. ST cancel out and you are left with KB minus KA. This is what you have to, this is what will be the net payoff. This will be the net payoff that you will receive in this scenario, in this region, KB minus K. And remember, KB is greater than KA, KB is greater than KA. So, this is greater than 0. This is greater than 0. So, what are we inferring? We are inferring that if our strategy is set up in this form, that we buy a call with a lower exercise price, we write a call with a higher exercise price, that is K is less than KB, then as the stock price goes up, as the stock price increases, we make a profit, and therefore, it is called a bullish vertical spread, because the person or the investor who is setting up this strategy will make a profit if the stock price goes up, as you can clearly see from this diagram, and the maximum profit that he is going to make is KB minus KA, KB minus KA. Now, the question arises, what is the sign of this? You see from here that KB is greater than KA. We had discussed earlier that in the case of call options, the premium is inversely related to the exercise price. Therefore, because KA is less than KB, the premium of A will be greater than the premium of B. The price of getting call A would be greater than the price of getting call B, because it is the right to buy. Buying at a lower cost, buying at a lower price means the call is more valuable, and therefore, because KA is lower, that option involving an exercise price of A is lower, and therefore, CA will be more higher compared to CB, and therefore, no please note, you are paying CA because you are buying call A, and you are receiving CB because you are selling call C. So, your net outflow or net cost, you may say, is CA minus CB. This is a cost, please note this. CA is what you are paying, and this is positive, please note this. CA you are paying and CB you are receiving. So, CA minus CB is positive, this is a cost. In terms of outflows, it would be negative, or you can write it as CB minus CA, which is an outflow, and therefore, this you can write as CB minus CA, because CB is an inflow, CA is an outflow. Therefore, CB minus CA is the net inflow, which is negative, and therefore, this has a negative sign. Now, there is a very interesting question. The question is, you have this as a call option, as a bullish vertical spread. Let me draw this. This is a long call. This is a long call. Now, the question is, why would an investor not take up this strategy, or why would an investor prefer this strategy instead of this? That is the big question. I repeat my question, why would an investor prefer a spread strategy, a bullish call spread compared to a long call? As you can see, in this case the profit is unbounded. As the stock price increases, as this ST increases, the profit also increases without any limit. However, in this case, as we saw just now, the profit is bounded, and the profit is bounded to KB minus KA. It does not go beyond that. So, why should I, in other words, why should I sacrifice this region of profit? This is, let us say, this is equal, this is the point KB minus KA. So, why should I sacrifice this region of profit? That is the big question. And what am I getting by sacrificing this region of profit? And there are, the answer is quite interesting. The answer is that I sacrifice this region of profit because I perceive, it is all a game of perceptions. I perceive that the stock price is not likely to go beyond this value x. The stock price is not likely to go beyond x. If my perception was that the stock price would go beyond x, I would rather prefer this strategy, at least insofar as this my perception is that the stock price would go as high as possible, as high as I perceive. Now, if the stock price I feel is not going to go beyond x, that means I do not expect to realize this profit, because I do not believe that the stock price is going to go beyond x. And because I do not believe that the stock price is going to be beyond x, this additional profit carries no value for me, carries no worth for me, because I do not, as per my probability analysis, this carries insignificant probability. So, what do I do? If somebody else feels that the stock price could very well go up and he could make a profit, he would be willing to buy a call on that, buy a call on this region, and I would be more than happy writing a call on this region, because I feel that the price is not going to go beyond this. So, that call that I write will never be exercised, and at least I will get compensation for the I will get compensation in terms of the premium on that call that will reduce the price of setting up my strategy. So, that is the reason that these spread strategies become popular. It's all in the perceptions, all in the minds of the investors, all how they feel about the stock price behavior at the time of maturity of these options. Because this investor feels that this is worthless as far as he is concerned, as per his own perception, he says, okay, I will write the call, I will get the premium on this, I will pocket the premium, I do not think I will have to, I will have to replenish or make the payoff against exercise of the call, because I do not think the call will be exercised at all, because I do not think the price is going to go beyond this. And therefore, I simply write the option, provided there is somebody else in the market to buy that option, it is well and good, and it is simply a question of demand and supply, and because that somebody buys the option, I get the premium, but I lose the right to profit on this region. And if it so happens that I turn out to be wrong, then I lose that extra profit, and because I will have to compensate the party who is long in that call, who will exercise that call, I have to compensate him by of this region of profit. These are the payoffs, payoff tables. These are the algebraic analysis of this spread. We have discussed all of this. Now, just one small thing, KB minus KA is greater than CA minus CB. KB minus KA is greater than CA minus CB. This is an interesting thing. Why it is interesting? Let us go back. Let us look at this. If I incorporate the premia also, and but ignore the time value of money, ignoring time value of money, you see Then CB minus CA is less than 0, we have talked about it. This is this see, let me quickly draw it here. This is the first region, CB minus CA, and then this is this growth, this is the profit, this is the 45 incline, and then this is this region. It is interesting to algebraically establish the sign of this, although it is quite apparent that this should be positive, but let us see if this expression turns out to be positive. It is quite simple. You use the put call parity, k b e to the power minus r t plus c b minus k e to the power minus c a is equal to p b minus p a, because S naught cancels out. You write the put call parity for both the equations. What is the put call parity? This is put call parity is c plus k e to the power minus r t is equal to p plus S naught. Write it for A, write it for B, A comma B, A comma B, A comma B, and this S naught will remain the same. Deduct A from B. So, K B plus C B minus K A minus C A is equal to P B minus P A. Now, what is the sign of this? Remember, what is the relation between K A and K B? K B is greater than K A. If K B is greater than K A, then P B has to be greater than P A, because the premia of put options are directly related to the strike prices, and therefore, this is greater than 0, and if this is greater than 0, we get K B minus K A, of course, ignoring time value of money for the moment. K B minus K A is greater than C A minus C B. That is what we needed to establish. Thank you. We will continue after the break.